Hello everybody and welcome back to the channel. In today's video we discuss stock, crypto and commodities markets right now, including the key earnings that are happening in the US and what that means about the next few weeks. We've got the Fed coming out next week with a massive interest rate hike that's going to hit markets, and we've got markets now testing a support that was tested 3 times this year. Will it hold for a 4th time? Let's answer that question hopefully right now. See you soon. There's a lot to discuss and a huge amount of volatility in these markets. All right, everyone. Well, welcome back to our daily market recap show here for the markets closed 26th of April, 2022. And as we said, it was a bloodbath across all of the markets. Everything was red really, and there wasn't really a sector to be safe in unless you were in dollars, that is US dollars. Markets really contracted. They fell around 4% for the Nasdaq and about 2.8% for the SP500. And what was it led by? Generally tech and tech-led stocks. We did have some after-hours results though, and they weren't all bad. Microsoft reported a very decent result. As you would know, I love Microsoft the most of any stock, and it was up 5% in late trading hours. Moat is a huge thing when it comes to that stock, and obviously Microsoft has one of the biggest moats in the world when it comes to investment. Alphabet, Google also resulted, and they didn't do so well. They were down almost 3% after hours and obviously falling underneath the support in our previous video did not bode well for them. It rallied and then it just dumped straight into earnings, and then after that. Where to next for Google? We'll take a look at that on the charts. Before we get into our normal analysis, I just want to bring up the Fear Greed Index. We're now sitting at a 26 fear. So we're almost entering extreme fear periods. Now, during fear, you often hear those famous sayings, things like Warren Buffett saying, be greedy when others are fearful. Is it time to do that? Well, we'll look at some of the fear index gauges today and actually try to figure out whether it is about time to really start thinking about these tech stocks and thinking about inflation a different way, etc. But when you look at their heat map for the day, nothing was really safe, particularly Tesla. It fell through our support early hours in terms of the open, and it was exacerbated by the Twitter buy. Obviously, Elon buying Twitter, market participants don't like that. They think the eye's off the prize. There are arguments both ways. Obviously, you could see Twitter as well being a very good social media platform to help promote Tesla. Maybe it's cheap marketing. There's different ways to think things, but negative 12% throughout the session, certainly a big one there. Nvidia semiconductors down 5.6, and Microsoft, Apple, Google just belting into lows. Amazon down 4.58 as well. Let's have a look at the broad market. As we mentioned, there was a small rally in the morning, and then they just continuously sold it off to get these big sell-off days. And when we look at the markets, it wasn't really any good sectors. I mean, energy held up okay by just stabilizing. Metals maybe stabilized a little bit. Utilities, XLP, defensive style sectors held okay for the session, but it was really just all about anything to do with growth was sold aggressively into the earnings report. So this brings up a point here of whether we're in some form of trap or whether we're in a really serious market decline. So we've basically seen the return to normal. I guess that's now included in the markets. That is, there was a bit of a trap that came through here. Now, obviously, we thought that we might hold up a little bit better in April from the S&P 500 standpoint. We did to a degree, but it was more sector-based than it was anything else. Technology really didn't hold that well. It ran in March and then it sold throughout April, and as we suspected, into earnings, it got dumped heavily, which was definitely one of the things we thought. We're now sitting down here on the support, and this is a critical point. Everyone's watching this level. We know that. And at this stage in the futures market, the market is holding up. But there are some big stats that could happen next. So let's talk about those. The first one is the S&P 500 when it breaks the 50 EMA. Now, it did so on the weekly a little while ago. But the stats after it breaks the 50 become very, very interesting, especially during midterm election years. You'll notice here that 85% of the time it goes to hit the 100 SMA. I'll show you where that is later on today's video. But 85% of the time it hits the 100 weekly SMA, and 52% of the time it goes for the 200. I don't think anyone probably wants the 200 unless you're feeling very bearish on the markets, because that really pushes us quite far down on the S&P 500. But 85% is an interesting stat and certainly something we consider. Now, whenever you're thinking about markets and you're obviously sitting here saying, are we in a recession? Are we in a problematic market? We've got to think about, do we have the signs? So we've obviously inverted. If you know US 2-year versus 10-year, that is a big indicator for a lot of people that we're about to go into a US recession. A lot of people believe we're already in one. It's possible and certainly could be happening. But throughout the last 50 years, effectively, percentage of US Treasury yield curves generally have been much higher before a recession. That is around 50% of them, all of the different yield curves have inverted, causing a recession later on. I still feel like this is an important indicator and we need to pay attention to it. So we'll keep bringing it up and we'll keep looking at it as we play through this year. The question of are we in a recessionary crash is very important because, of course, that will help us whether we can, buy up or not. Another thing about midterm years, as we know, is we always expected a secondary down push here. And in general, actually, the problem with these stats is that later on in the year, we might even actually drop again. And that's the problem with 2022. It's going to be incredibly choppy. Most big technical analysts and most big investors know this. So a lot of them tend to find lows during the weakest months of the year, which are usually August and September. So we'll certainly have to consider that and something that we might need to think about, even if we rally again off these points later on. In terms of earnings seasons, beats and misses, a lot of people are making a big deal about the US not doing so well. Obviously, the forward predictions of the economy may be a little bit soft. But in general, the beats rate sitting at 81% with 255 beats and 59 misses. We'll continue to update you guys through the earnings season. And obviously, we'll continue to follow this stat. And speaking of earnings, we have some big ones still to go. We've got Meta, we've got PayPal. Reactions on those will be super important. And then we have Apple and Amazon. And both of these stocks have now almost slammed straight into support. So they're going to be trading right around support, possibly bouncing here in the next 24 hours after that huge reaction in the last 24 hours of trade, but certainly at key levels ahead of earnings. And that usually is what happened. Microsoft was sitting straight on support ahead of earnings. Then the earnings came out, it's bounced. Alphabet went underneath, rallied, and then sold straight back down to the support, and now is underneath that level. So a lot of people would talk about fear all the time. How is a good way of us reading fear? Well, of course, it's got to do with the fear index, the VIX, the volatility index here. Oftentimes, if the fear becomes high, that is, it hits certain levels such as maybe 35 here on the VIX, many people look at that as possibly a time for them to start to really sniff out potential buys if they are bullish over the medium to longer term or even the shorter term. This is what we're fast approaching. Now, obviously, this doesn't always work. And if you go through time, there are points in time where VIX goes even higher, such as the pandemic. And you'll notice here it went absolutely ballistic. But in general, for the last couple of years, we've been able to hold here around this 35 to 40 on the VIX. So it's certainly an interesting point. And obviously, we're hitting this fear right around a level of support. Very interesting indeed. Let's move over to the US 10-year. So a lot of people look at the US 10-year. In fact, this is one of Buffett's favorite indicators, although he is an investor. Many traders as well look at the US 10-year. It helps us to get a good idea of what's going on in terms of the market set the 10-year, and the 3-month and the 2-year, remember, is set by the Fed. The Fed set that time, the market sets the other one. That's why inversion is such a big deal. So it's actually been decreasing here recently, and that might be an okay signal. Now, this has been one of the things that we really have been discussing. So, of course, 3%, here we are. Resistance, 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 and we've sold off that level. In fact, if you were trading treasuries right now and you were selling that top, you'd be pretty happy with yourself. But in general, it's dropped to 2.73, and that's not necessarily a negative thing for tech. It's probably a positive thing, especially if it continues to drop and tech continues to get hit. Overall, that could be a positive thing because they are correlated together to a degree here, at least on the short. Let's talk about PCC, and this is put-call ratio. Basically, how many puts are being entered, how many calls are being entered into the market. It's dropped a little bit here, but I can tell you when we look at some option stats later that the market has been very good at getting people to buy the last 24 hours and, in fact, the last week heading into earnings. A lot of people have been placing calls into the market. We can see them literally sitting there in open interest. The DXY as well has been an early indicator and certainly a huge one. We've discussed this a few times now on the channel in recent days, and we've been talking about this huge breakout here in the DXY. What is this telling us? Well, the problem is it's kind of telling us that market's coming out, or money's coming out of the market, and it's not necessarily going into another rotation. It's not going into metals. It's not going into energy. It's just sitting in US dollars. So if we start to see the DXY dropping, what's that probably telling us? Maybe smart money is exiting the US dollar and going back into the market. One I would watch on your daily indication here, and you'll notice that the DXY is going for gold. It's basically trying to get up near that 103. We've been very bullish on the DX now for quite some time, especially over here back in October of 21. We were very, very bullish on the dollar, and we have been so since that point. And it's about to hit a very key level that we believe could cause some significant issues for the dollar index. It's on an absolute run. So around 103 could be an interesting point. Remember, it's packing in price as well based on what they believe the Fed's going to do, which is, of course, raising rates moving forward. Let's talk about gold. Gold versus US dollars been kind of struggling. It's a currency after all, really, gold. I mean, obviously people see it as a hedge, but in many ways it is a currency. It's finding support at the 20 moving average on the weekly. And you can see this has been a point where it's bounced many, many times. Do you know it's going to bounce off this area? Well, right now it's not really doing enough. If we go into something like a 1 hour, it doesn't really look very strong. I mean, it's kind of sitting there consolidating. Maybe if it breaches past these resistances, there might be a bit of a scalp upwards to here or 1940. But in general, you've got to be a little bit careful here in gold at this level. This is many times now it's come back down. And at the moment, some people will be calling that a flag towards the short. So be careful there. Where things get a little bit more interesting is probably something like natural gas. Now, natural gas was the hottest thing for quite a while. And we've been following the natural gas story a little bit here on the channel. It breached. It's gone kind of euphoric, and now it's busted back down. Generally speaking, markets that do this, they tend to like going back up a little bit first and you know, having a short kind of run on them. So I'm thinking the 61.8 here, a breach through this level could certainly push us towards that, or the 78.6. And this is going to be an area that I think a lot of people are going to be focusing on for the bull side. So natural gas actually is interesting, even though it's completely busted down. There are some strong points to be said that if we breach through this point of around let's call it 7.19, 7.2, that maybe we're looking at a small gain here over the next couple of days. Remember, when you're unsure about the markets, possibly other markets become opportunities to you. So we said we mentioned Tesla, and we certainly will. It was a bloodbath. Like, frankly, this was a massive sell-off. I think, again, it was partly just the market taking advantage of a huge amount of calls that were probably bought through based on the earnings result. They want to expire all of those worthless. We know retail traders tend to be bullish on Tesla. And when it breached past this coil level, I mean, a few of you probably shorted this because we were talking about the short for a long time. Now, obviously 940 was the next level that we thought it would get to straight away, and it did. But it didn't even bounce. It didn't even show any signs of bouncing. Let's have a look at this on a 5-minute chart. It just went straight through it. It just went bam, 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 bam. And then by the end of the day, it was on its low. So yeah, it was a significant sell-off. Quite difficult to get. Obviously, a series of lower highs coming in. If you just shorted underneath, which was totally fair. I mean, look at this. It's not like we haven't talked about this level a million times. That was a huge support. And when it breached, it did so in style and it sold off. I'm sure a few of you did it. I'm sure a few of you were pretty careful about it. Remember, when you hit a support of any kind, you should be waiting for some form of bounce. Now, the way we look at it is you should look at a lightning bolt, a double bottom on a smaller time frame, some signal of turnaround before you consider buying a support. Otherwise, you're buying a falling knife. And if you caught a falling knife, obviously it's going to cut you up. You don't want that. So you don't want to be in the hospital getting bandage surgery or stitches or anything like that. We don't want to be there. So that's why when it comes down like this, it gets pretty fierce. Let's now talk about where it's currently at. So it really fell heavily. I mean, basically it went all the way down to where it first bounced in December of 21. And it even went underneath that. So it went resistance here. It bounced off this low last time. Will it do it again? I think it's too early to tell. I mean, it It will probably bounce in early hours just because the rest of the market's bouncing off support. But you do need to be careful. You've got here support, resistance. Obviously, there could be a little bit of support around here. But for a sustained bounce, we're going to need lightning bolt action similar to what we saw over here, where we became very bullish on Tesla at this point. Obviously, trough, peak, higher peak, great consolidation, good times ahead for Tesla, and it was. Now we're at a point where, yeah, it's a zone, but we've come slamming into it, and we still have Apple and remember Amazon to come and Facebook. So all of those are going to be really taken into account once we're seeing this rally around. Depends on the type of time frame that you're on. Let's look at Microsoft. So as we mentioned, Microsoft up in after hours trade, sitting right at support, earnings, bang, that's what happens. It's at a point of critical point here. Microsoft's a great stock. It will move with the rest of the market, but it was up around, I think, 5% after hours. So we basically managed to move back to around this level here, 283-ish. Not too bad, and obviously a great stock from a moat perspective. Where it gets much more negative is Google. Now, we cautioned this one. Of course, it had support. And a lot of people are saying, but Tom, we've got the split coming up. And I do think the split trade will come through, but this is much more powerful forces than just a split happening. And remember, the split's over here in July. So what if the market was to go and hit 100 SMA on the SP 500? We saw Google bottoming, creating a lightning bolt ahead of the split. Is this still a quality stock? Yes. Is it a really good quality stock? Yeah, it is. I mean, it's a very good quality stock, and it may have great technicals in the future. But when you look at this chart, unfortunately, unless we breach back above here, it doesn't really look very strong. It kind of looks like it's ready to keep going and potentially sell off a little bit. So we need to be careful there. There might be a rally on a day, but sustained wise, it still looks relatively negative. Let's talk about Amazon. Amazon coming straight in here ahead of earnings to the dreaded level of 27.40.50. Now, last time, what did they do? They announced split action to try to get away from this level. They were like, please, we need to go away. And they announced the split and pulled it back up. I think that was here. This time around, what are we going to do? Well, earnings will come in and we may be sitting right on support. So I think it's unsure where the American consumer is looking good. If we look at XLY, which is effectively the entire American consumer, this is consumer discretionary, at the moment, it's not even on support yet. It's still breaking down and potentially going towards that 161. So this sector, which was something we watched, is suddenly looking very sick and not looking good at all, and may have more to fall in it. Apple is similar, coming down into support ahead of earnings. It's going to be your best guess the way this is going to run out. Like, that's the way that this earning stuff works. If you're going to do it, maybe you need to do it with risk adjusted, something like an option, something like that may help you out. But let's now look at semiconductors as well, breaking down lower. Semiconductors not looking good. We mentioned Nvidia looked absolutely horrible after it got through that 210 area. And since 210, it's gone all the way to 187. Is it a good stock? The answer is yeah, it's a good stock. It's got great earnings. It's got great potential, blah, blah, blah. But the problem is it's also valued very highly. So the market is punishing these kind of positions right now. Could they push it even lower? The answer is unfortunately they could. And I could see it maybe even falling into its previous kind of consolidation zone before all of this hype and euphoria came into this stock around the split and everything else. So will we go back to like a 160 for Nvidia? At this stage, semiconductors and Nvidia doesn't look too good on the charts. We don't have a turnaround story, at least at this point in front of the charts. Let's now talk about the Nasdaq. So the Nasdaq has slammed straight into the lows. The lows formed in February, the lows formed in March, and now the lows formed at the end of April. We're ahead of the Fed. So the Fed's going to raise rates. We know this. They're probably going to do 50 basis points. I doubt they do less. And they're going to do it next week. So depending on earnings, we may actually break through here. But will this be a buy the fact? That is, when the Fed actually make the move, the market's already punished everybody enough to go in. Remember, it's all about tricking and trapping and being reactionary in trades. That is, if we understand what the market's trying to do, maybe flush people out, that when the fact comes in, will it rally? Last time it rallied off the fact. Here's the fact. Raise rates, boom. Will that happen again? Will we see another raise rates boom? So we're at support. I can see why people are probably trying to buy that after hours. That is, they're trying to get into this market and push it up because it's a huge level. I mean, everyone can see this level, yeah? And depending on what happens now, we have to wait for the other earnings, and they're going to be the ones that push it through. We need powerful forces to get through stuff such as these supports. You would think it's going to be the other earnings. So we may see a relief rally, but we've got to be very careful. Things like 13,250, previous little bit of support there, will now act as resistance. It's still sell the rip market, unfortunately. That's the way we see it until we get the lightning bolt up, until we see something. Look at this. Last time we were talking about it, we never breached through. We tried multiple times and it consolidated and then just got absolutely smashed back down. And it gets a little bit worse because, of course, the SP 500 at the time of recording is bouncing. So that's good news, I guess. But we are at the level that is bounced every single other time, and we're right there right now. So if we break through this zone down here, where's the next logical conclusion? Well, I think it certainly becomes very likely, because of that 85% stat, that as soon as we breach underneath here, we go towards 4,000. And I would say 4,000 will be the level, around that level, psychological zone. So if we get underneath here, 4,000 becomes likely. And if we're ahead of 4,000, ahead of the Fed, you don't want the market too much lower than this, because then you start to enter full bear market territory. Remember, the Nasdaq's basically in a bear market. The S&P 500 can technically wear up to 3,800 before entering technical bear territory, yeah? So these levels here, this is where you expect buyers to try to get committed back into purchasing. But at this stage, it's still a sell the rip market. That is, any rally is going to be met potentially by sell demand. And that's the problem. Until we see otherwise, you're looking for signs that the market's trying to sell around here. If it is, then of course it's sell demand, like it has been every other day so far since over here. And of course, since really the lightning bolt first started, which was back over in this area here. We had our peak, we had our trough, we had our lower peak. And every time we tried to rally, we failed to do so, unfortunately. So yeah, we're right around the support. If it breaches underneath, we've got kind of some big problems here. We could drop another 150 points relatively quickly. We've got the Fed coming out. And the worst thing about it is that everyone keeps buying calls. Max Pain continues to drop. That is, effectively, there are more and more calls being opened into earnings season, which means more and more traps that Wall Street would like to obviously not pay off. And yeah, that's been dropping now consistently. Like if we look at the 27th for expiry here, it's 430 on the max pain for those options expirations. For the 29th, it's 436. So it's dropped considerably, about $15, $14 since last week. And if we look at the calls, There's all these calls sitting around 450, 460. They did a good job of getting people in. And in general, there's a lot of calls sitting around in comparison to the puts they expired last week, and then they pushed the market straight back underneath it. So if you ever want more proof that they really do trap people into psychological trades, this is what's happening, unfortunately, in front of our eyes. There's still a lot of people going long on calls, and that's why it's still a sell the rip at this stage anyway. Let's move over to Bitcoin. Bitcoin's really just risk on, risk off. So at this point, it's just going risk off. And that's because, of course, the Nasdaq got hit. It's holding okay. I would say this is doing better than you expect. I mean, you might expect it to be on March and Feb lows for now. And that's, yeah, it's doing okay. But it's going to be hard to read Bitcoin without seeing the Nasdaq moving back up. I think Bitcoin sometimes precurses it, but we still have a decent amount of shorts in the market, and that's still rising. You'll notice here it almost started shorting off. That is, there was less nasty whales trying to short Bitcoin, then it suddenly reversed, and now there's more nasty whales trying to short Bitcoin again. So if they're trying to short, I don't like to fight them. I like to see declining BTC shorts and increasing price action. I think with Bitcoin, if you're looking at it on a chart, the real clarity you'll get is if we're able to breach through like 42,000 again with a closure. Something like that would be a big deal. But at this point, it's kind of like a bit of a coin flip. If you haven't already, come and follow us over on Twitter. We're almost at 5,000. Thanks so much, guys. We appreciate that. At FX Evolution is the handle. We do share stuff over there. and we'll be doing so even more in the future now that Elon owns it, or he will. And remember, next week, FOMC statement funds rate coming out Wednesday, May 4th. And this is the time that we'll see the market have its little kind of reaction. Will it be a buy the fact, that is, the actual rates go up and the market loves it? Where are we at that point? Well, I think we're going to find that out once we see Apple, Amazon, and Facebook come through. But so far, earnings season's been okay overall, but not great in the tech. And of course, if others such as Facebook miss, and especially if Apple miss, get ready to get through that support, because if Apple misses, it's going to be bad, and we're going to move down very quickly, I would say, in these markets. Thanks so much for watching. If you enjoyed today's video, please remember to subscribe, smash that like button, and we'll see you in the next one. Bye for now.